There is an old haunting saying on Wall Street. History doesn't repeat itself, but it often rhymes. And right now, if you listen closely to the charts, the stock market is singing the exact same tune that it sang in 1929, right before the lights went out for an entire generation. I recently took the historical stock chart of the 1929 supercycle, the massive run-up that created the Roaring '20s, and I overlaid it directly against Nvidia's performance chart for 2024 and 2025. The result wasn't just similar, it was terrifyingly precise. It looks like a glitch in the simulation. The trajectory, the velocity, and the steepness of the curve are identical. In 1929, the entire world was convinced that the market would go up forever. They believed they had entered a new paradigm of permanent prosperity, driven by a miraculous new technology that was going to change human civilization. Back then, the technology wasn't artificial intelligence, it was the radio. But the human psychology, the blind greed, the excessive leverage, and the religious faith in the future was exactly the same as what we are seeing today with AI. Most investors look at Nvidia hitting all-time highs and they see a victory lap. They see a company that is printing money. But when I look at that chart, I see the first 3 warning signs of a massive historical correction. We are seeing valuation ratios that defy the laws of gravity, a hidden explosion in margin debt that nobody is reporting, and a dangerous narrative that this time is different. I am not saying Nvidia is a bad company. In fact, the company I am comparing it to from 1929 was also a phenomenal company. But I am saying that the price has detached from reality. And when price detaches from value, gravity always wins. In this video, I'm going to walk you through the 3 specific signals that flashed red in 1929, signals that most people ignored until they were bankrupt, and show you exactly where they are appearing in Nvidia's chart today. But before we break down the math, I need to make a deal with you. This channel is about revealing the uncomfortable truths that the financial media glosses over. We are currently racing to hit 1,000 subscribers by December 31st, 2025. If we hit that goal, I am going to release a killer video. This is a video I have already written, but I am genuinely afraid to upload it because it exposes a specific mechanism the elites use to rig the game. I will only release it if we hit the goal. So if you want to see the video that might get me banned, hit that subscribe button right now. Now, to understand the trap we are in, we have to go back to the euphoria of the 1920s and meet the Nvidia of the Jazz Age. To understand the Nvidia trap, you have to stop looking at the current charts and meet the grandfather of the 1929 crash, the Radio Corporation of America, or RCA. In the 1920s, radio was the artificial intelligence of its day. It was a technological miracle that allowed the human voice to travel invisibly through the air. Everyone knew it was going to change civilization, and they were absolutely right. It did. But here is the trap that destroys investors over and over again. Being right about the technology does not mean you are right about the stock price. Just like Nvidia today, RCA was the darling of Wall Street. It was the stock you had to own. Investors bid the price up by 500% in a massive speculative frenzy, convinced that traditional metrics like earnings and dividends didn't matter anymore because we had entered a new paradigm. I know what you are thinking right now. You are thinking, but Nvidia is different. Nvidia has real revenue. Nvidia is profitable. That is exactly what they said about RCA. They argued that the future possibilities of radio advertising were infinite. People leveraged their houses to buy shares at the top. But when the bubble finally burst in 1929, RCA didn't just correct. It lost 90% of its value. Think about that. If you had invested $100,000, you were left with $10,000. And the scariest part? RCA stock didn't recover to its 1929 price until the 1960s. An entire generation of investors lived and died before they broke even. We are seeing the exact same psychological setup right now with artificial intelligence. The technology is real. The revolution is real. But the mania is dangerous. The narrative has taken over the math. People are buying Nvidia not because they have analyzed the cash flows, but because they are afraid of missing out on the future. They are buying the story, not the business. And history tells us that when the shoeshine boy, the average person on the street, starts giving you stock tips about the hottest tech company, the top is usually already in. The story of RCA proves that a great company can be a catastrophic investment if you pay the wrong price. And that brings us to the first mathematical warning sign that proves Nvidia is currently priced for perfection and positioned for a fall. Before we look at the first math signal, I have a test for you. I have hidden the ticker symbol of the ghost of 1929 somewhere in this section. It will flash on the screen for less than a second. If you spot it, comment it below. Only the true insiders who are paying attention will see it. Now, let's look at the first warning sign. The price to earnings, PE, expansion. This is the heartbeat of a bubble. In a healthy market, you pay for a company based on the cash it makes today. In a bubble, you pay for the cash you hope it makes 10 years from now. In 1929, right before the crash, stocks were trading at 30 to 40 times their earnings. At the time, those levels were considered insane. Economists warned that it was mathematically impossible for companies to grow fast enough to justify those prices. But nobody listened. They said, math doesn't apply to the new era. Today, we are seeing the exact same delusion. Nvidia has frequently traded at PE ratios far exceeding 60 times or 70 times. And some AI startups are trading at infinite valuations because they have no earnings at all. This chart shows the P/E ratio formula. Price divided by earnings. It's a simple fraction. When the price, numerator, goes up but the earnings, denominator, can't keep up, the ratio explodes. This creates a situation called priced for perfection. When a stock is priced this high, it implies that the company will have zero competition, zero regulatory issues, and infinite growth forever. There is no room for error. In 1929, the bubble didn't pop because the companies went bankrupt. It popped because the growth slowed down just a tiny bit. The moment the infinite growth story cracked, the valuation compressed violently. For Nvidia, the trigger could be anything. Amazon making its own chips, a Taiwan geopolitical scare, or just a slow quarter. The valuation leaves you no margin of safety. It is like walking a tightrope over the Grand Canyon without a net. You might make it across, but if you slip, there is no second chance. But high prices alone don't cause a crash. You need fuel for the fire. And that brings us to the second and most dangerous warning sign, the one that actually caused the Great Depression. Stop. Listen to me. This is the most dangerous part of the video. If you tune out everything else, listen to this. High prices do not kill markets. You can have an expensive stock market for years and it won't crash. What kills markets, what causes the sudden, violent 30% drops that wipe out accounts overnight, is debt. Specifically, hidden leverage. In 1929, the market didn't implode just because RCA was expensive. It imploded because everyone from the banker to the shoeshine boy was buying stocks on margin. Back then, you only had to put down 10% of the cash to buy a stock. The broker lent you the other 90%. This was magic on the way up because it magnified gains by 10 times. It made everyone feel like a genius. But leverage is a double-edged sword. The moment the market dipped just a few percent, the brokers issued margin calls. They demanded more cash immediately. When the shoeshine boy didn't have the cash, the broker automatically sold his stock. This selling drove the price down further, which triggered more margin calls for the next guy, which triggered more selling. It created a liquidity cascade, a trapdoor that opened under the entire economy. You are probably thinking, well, we have rules against that now. And you are right, we do. But Wall Street always finds a way to gamble. Today, the leverage isn't in plain sight. It is hidden in the options market. Retail investors are buying record amounts of call options on Nvidia. An option is basically a leveraged bet. When you buy a call, the market maker on the other side has to hedge their risk by buying the stock. This drives the price up artificially, a gamma squeeze. But if the momentum stops, that mechanical buying turns into mechanical selling. We are also seeing the carry trade, where massive hedge funds borrow cheap money from Japan, yen, to buy tech stocks in America. The system is leveraged to the hilt, just like in 1929. The only difference is that today, the selling is done by algorithms in microseconds, not by brokers on a telephone. This means that a 10% drop in Nvidia won't just hurt your portfolio. It could trigger a forced liquidation event that you can't react to fast enough. The trapdoor is primed. The explosives are laid. The only thing keeping us from falling through it right now is the belief that the trapdoor doesn't exist. And that brings us to the final psychological warning sign, the narrative that blinds us to the danger. The final warning sign is psychological, and it is the hardest one to see because it feels so good. It is the belief that trees grow to the sky. In every bubble, there is a moment where the experts decide that the old rules of economics no longer apply. In October 1929, just days before the crash, the most famous economist in America, Irving Fisher, stood up and declared that stock prices have reached what looks like a permanently high plateau. He argued that American industrial innovation had defeated the business cycle. He believed the market would never crash again because the technology was just too good. Does that sound familiar? Turn on CNBC today. You will hear the exact same words, just swapped for 2025. AI will change everything. Data is the new oil. Nvidia is selling the shovels for the greatest gold rush in history. The narrative is identical. And to be fair, the future crowd is usually right about the technology. Radio did change the world. The internet did change the world. But the investors who paid 100 times earnings for RCA in 1929 or 100 times earnings for Cisco in 2000 still lost 90% of their money. Being right about the future doesn't save you if you overpay for it. This leads me to the question of the day, and I want you to be honest. I want you to go on the record before we see how this plays out. Do you think we are in a massive, hype-fueled bubble that is about to pop? Or is AI truly the future that justifies these insane prices? Go to the comments right now and type just one word, bubble or future. I'm going to read through them to see where the sentiment is, because historically, when the majority screams future, the top is usually already in. The blind faith in the narrative is what blinds investors to the risk. But you don't have to be blind. There are specific steps you can take right now to protect yourself without selling everything. So, if the charts are screaming that 1929 is rhyming with 2025, what do you actually do? Do you panic sell everything and hide cash under your mattress? No. That is how you miss the upside if the bubble keeps inflating for another year. The survivors of the Great Depression, the few families like the Kennedys or the Rockefellers who actually grew their wealth during the crash, didn't panic. They simply played by a different set of rules. The first rule is what I call the house money strategy. If you are sitting on massive gains in Nvidia, let's say you are up 100% or 200%, the smartest move isn't to sell everything. It is to sell your initial investment. If you put in $10,000 and it is now worth $30,000, take the original $10,000 off the table. Put it in cash, gold, or government bonds. Now, you are playing with house money. If Nvidia goes to the moon, you still participate. But if it crashes to zero like RCA did, you haven't lost a single dime of your own money. This psychological shift is the only way to stay rational when everyone else is drunk on greed. I bet you have a friend who is all in on Nvidia right now. A friend who screams, "diamond hands," every time the stock dips and refuses to take a single dollar of profit because they think it's going to $1,000 a share. Do them a favor. Share this specific part of the video with them. Send it to them right now. They might hate you for it today, but they will thank you when the correction hits. They need to understand that taking profit isn't betting against the company. It is betting on your own survival. The second rule of the survivors was ruthless diversification. In 1929, the investors who got wiped out were the ones who were 100% concentrated in new tech stocks like radio. The ones who survived were the ones who owned boring assets, real estate, gold, and utility stocks. When the bubble popped, the boring assets held their value while the tech stocks evaporated. Don't let one ticker symbol determine your entire financial destiny. Set a trailing stop loss, a mechanical rule that automatically sells your stock if it drops 15% or 20% from the peak. This removes your emotions from the equation, because when the crash happens, it won't happen when you expect it. It will happen when the narrative is the strongest. And that brings us to the final lesson from history. The pattern is clear. We have the valuation gap of 1929, where prices have detached from earnings. We have the hidden leverage of 1929, where the system is built on a mountain of debt that can collapse with a single spark. And we have the euphoric narrative of 1929, where the smartest people in the room are telling us that this time is different. Nvidia is a phenomenal company, just like RCA was a phenomenal company. But you have to understand that a great company can be a catastrophic investment if you buy it at the wrong price. The market is screaming warnings at us in the language of mathematics, but it is up to you to listen. Most people will ignore this video. They will call it FUD. They will say I am bearish. They will keep chasing the green candles until the music stops. And just like in 1929, they will be the ones wondering where their life savings went when the liquidity dries up. But you don't have to be one of them. You have the charts. You have the historical overlay. You have the house money strategy. You can choose to be a hunter who waits for value, rather than a chaser who gets slaughtered by volatility. This brings us back to our mission. We are building a bunker for the investors who actually want to survive the next decade. We are racing to hit 1,000 subscribers by December 31st, 2025. If we hit that number, I am going to release the killer video. This is the script I wrote about the real reason the Federal Reserve was created, the one that exposes the mechanics they use to siphon wealth from the middle class. I am genuinely afraid to upload it because channels get demonetized for talking about it. But if we hit 1,000 insiders, I will take the risk and drop it. So, you have a choice. You can go back to watching the hype channels that tell you stocks only go up. Or, you can click that subscribe button, join the insiders, and unlock the truth. I don't want you to be the shoeshine boy left holding the bag when the window closes. I want you to be the one who saw the cliff before we drove off it. History is a brutal teacher, and it usually gives the final exam before the lesson. Let's make sure we pass. Class dismissed.